Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
One of the questions that FX options traders are having to deal with is, well, do I spread the trade? Do I go long, just an outright call or put? Do I short an option potentially? And quite often I find the answer to that question is, well, where do I think the market's likely to go? What's the option strategy that's going to fit the opportunity the best? Because a short move or a flat move, selling an option might be the way to go, versus a large anticipated move, being long an option would be the way to go. And when I get to the case study we're going to look at as far as where the Forex pairs are today, I've got an illustration of exactly what I mean. So, but let's look at another currency pair. So YUK, this is the Japanese yen, and it's inverted from what we were just looking at. So it's an interesting one because it's the on this currency versus the dollar equation here. The dollar is on the other side. So what this one is telling us is that right now it costs $90 or 90 yen to the dollar, so it's just on the opposite side, meaning that if the dollar yen here or YUK is going up, the dollar is getting stronger. Which, that's more or less what we saw on the euro here, where, beginning of December, things started to improve in value for the dollar. And that's not quite as robust of a trend here with YUK, but we have been seeing that dollar strengthening happen here as well. Now, so here's let me show you a recent example where we would have been looking for the same thing, applying a Fibonacci retracement. And from the top to the bottom of this particular trend that we've identified, has had a bounce. So we're looking for where's that likely resistance level that's going to precede the a resumption of the previous trend. And we've got a candidate appearing right now. So since the market began to rally again in the beginning of February, we've hit the 61.8% retracement level, one of these candidate levels, answering the where or when we might want to time our entry. And now we still have the unanswered question of, well, where do we think it's going to go? What's our projection? We're gonna get to that here in a minute. But if this is a valid bounce down from resistance, then we've got an opportunity potentially that we would want to analyze a little bit further. In fact, it's interesting. Let me go back a little bit. I'm going to look at a prior trend. So we're gonna attach our Fibonacci retracement to the big move up in favor of the dollar that occurred from the very end of November towards the very beginning of January. And you'll notice that at this point, this same level that we're dealing with right now as a potential transition point, a change in the short-term trend, is still lined up with the Fibonacci retracement level. This happens a lot, actually. The theory behind Fibonacci retracements is that they kind of line up with the natural cycles in the market. And while they're not completely regular, obviously, they do tend to kind of repeat themselves in these similar orders of magnitude. So seeing the market hit a resistance level here at the same point that it would have been identified as a candidate resistance level by applying the Fibonacci retracement from the end of November through the beginning of January is normal. We would expect to see that a lot, in fact. Now, there's the tool we've been looking at so far is a retracement, which, as I mentioned, it's just you anchor it from one end to the other end of a trend segment, and it's going to subdivide that trend into these ratios, which then each become a potential inflection point in the market, where a change may occur, and we can take advantage of that potential change to time an option trade. So, I mean, even as basic as buying a put, let's say, at resistance or something like that. But that's not the only Fibonacci tool out there. And it's definitely not the only way to use this particular tool, which I'm going to, because we can use the same tool to identify projections as well as potential entries. So we can answer not only the when we might want to get in the trade, but where we think that trade might go. This is a handy tool, but there's others as well. So there's another way to kind of parse the same information. So I've just grabbed another tool here, and I'm going to apply it basically from the same level. So from the bottom of the market, the very end of November here, to the, I've anchored it to the top of the market. You can see my little dashed line here, the top of the market, the very end of January. So the same trend, and it's drawn some Fibonacci fan lines. So these are diagonal lines that do essentially the same thing. They take the vertical distance of this particular trend. So let me just draw a quick line here. So they essentially look at a line drawn from the very top of the trend straight down to the bottom of the trend. And then they divide it by 50%, 38.2%, and 61.8%, which is why you'll see them kind of crossing those levels at exactly that point. So that's where we get this little intersections here. So it's the same way to look at virtually the same information, or it's a different way to look at virtually the same information, but because Fibonacci analysis doesn't introduce a lot of lag into your trading, like if you were to layer on a whole bunch of technical indicators, you would layer on a whole bunch of lag too. So it's tough to do that. You know, indicator piling can be a bit of a danger. But it's not as risky. It's not as problematic when you're working with like Fibonacci retracement. So as a for instance, you'll notice that both the fan lines as well as the retracement lines intersect right here at that same level we're dealing with right now today. Well, that's always a point that I pay a lot of attention to. The same thing occurred, by the way, all the way back here in the very end of January. So those, when the retracement line and the fan prices kind of line up at the same point, I can't really explain it empirically, like why that happens, but it does tend to coincide with a lot of big moves. So when you're taking a fairly speculative bet, if you're trading an option, or potentially if you were long this currency pair and you're using FX options to hedge some of that risk, maybe you're going long a put or something like that to cover your losses in the near term if the market does retrace, it's a pretty good technical trigger that there may be a transition in the market. So we pay a lot of attention to it. It's just one of those things that I would point out. Okay, so let me. I want to go back to the euro here, and we talked about the fact that the euro had one of these potential resistance areas identified by the Fibonacci retracement back in here in middle of January, where we get our opportunities, start thinking about where is this entry opportunity likely to be. So we might choose a bearish trade at that level. We'd start thinking about some of the bearish strategies that we might put into play here. But where do we think the market might go? Because that's going to make a big difference as to how do we manage our risk and what kind of a trade would we take.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.